Today what we'll do is we'll go over the examples for chapter 14 of what some of the, which these should be similar to what some of the homework was about. So the first example we'll look at is how do we record bond issuance at par, the interest, payments, and bond maturity. So on January the 1st of 2019, Brussels Enterprises issues bonds at par dated July the 1st of 2019, or January the 1st, 2019, that have a $2,400,000 par value, mature in 4 years, and pay 9% semi-annually interest on June 30th and on December 31st. And so the first entry that we will make will be the issuance of the bond. The second entry will be the interest payment that would be from June, and then we'll make the next interest payment that would be due in December, and then we will record the entry for the maturity of the bonds on December 31st, 2020. And we will just go ahead and assume that the semi-annual interest was already recorded. So in order to record the issuance of the bonds, you would debit cash in the amount of $3,400,000, because that's the amount of cash that Brussels Enterprises is receiving for the bonds. And then you would credit the bonds payable $3,400,000, because that establishes the long-term liability for the bonds. And then, in order to record the interest, the first semi-annual interest payment, you would record a debit to bond interest expense for $153,000. And we figured that out because we also have to credit cash for the amount of the interest that we're paying. And so you take $3,400,000, multiply that by 0.09, which is the interest rate, the annual rate, divide that by 2, because you're going to pay it. 9% is the annual rate, but you're going to pay it out over 6 months of it, and then 6 months of it. So you do that. And so you can do the same thing then for the second payment in December, is you would debit the bond interest expense $153,000, credit cash $153,000. And then finally, to record the payment of the actual bond at maturity. So in this case, it would be paying the principal of the bond, which is the $3.4 million, is we would record a debit this time to bonds payable for $3,400,000, and then we would record a credit to cash for $3,400,000, recording bond issuance and interest. Okay, so on January the 1st, Boston Enterprises issues bonds that have a $3,400,000 par value that mature in 20 years and pay 9% interest semi-annually on July the 30th, or June the 30th, and December 31st. The bonds are sold at par. And so first of all, we need to figure out how much interest will Boston pay in cash to the bondholders every 6 months. So the par value is $3.4 million, and then the annual stated rate, or semi-annual, would be 4.5. So you take 9%, divide that by 2, you get 4.5. So that's how much every 6 months. You multiply that, you're going to come out that the semi-annual cash payment is $153,000. And so again, kind of looking at it again, I'm just going to kind of skip through this because this is exactly the same thing as we looked at previous. Now what we're going to do is we're going to figure out then how do we record if it was paid, either if it was sold either with a discount or a premium. So the first one would be with a discount because it's going to be at 98. So we see here then that we would have a debit to cash, so of 3,332,000, because that would be 98% of the 3,400,000, right? And then the discount on bonds payable of 68,000, because they're still going to have to pay the full amount regardless, but they're just not going to collect that up front. And then the bonds payable then credit for 3,400,000. Okay. Now the next one, B, is going to be if it's sold at a premium, meaning that they're getting more initially than what the face value of the bonds is. So again, cash would be, again, 3.4 million multiplied by 102% is $3,468,000. And then you would credit the premium on bonds payable. In this case, it would be 68,000, and then a credit, and then we'd have a credit to bonds payable in the amount of 3.4 million. A straight line amortization of bond discount. Tano issues bonds that have a par value of 180,000 on January the 1st of 2019. The bond's annual contract rate is 8%, and the interest is paid semi-annually on June the 30th and December 31st. The bonds mature in 3 years. The market rate at the date of issuance is 10%, and the bonds are sold for $170,882. And so first of all, we need to figure out the amount of the discount at issuance. And so 180,000, we can subtract from that. That's the par value is 180,000. 170,862, that is the amount that we're selling the bonds for. And so the amount of the discount on the bonds is 9,138. And then how much total interest expense will be recognized over the life of the bonds is, we know that it would be 6 semi-annual payments of $7,200. Again, 180,000 multiplied by 4%, because we said that it's going to be, and the reason for that is because the bonds mature in 3 years, but we're going to make 6 payments. So 6 payments, and then at 4% interest. So you take the 8%, divide that in half, so you get 4%. So it works out. So the total amount, well, first of all, you have that, and then you have the bond discount of 9,138. And so the total interest expense recognized would be 52,338. Because you're going to end up paying the full amount, even though you didn't receive it initially of the 180, you're going to end up paying 180,000 at the end. And then again, there's that. And then so we'll use the straight line to amortize. See that we have, these are the periods of when the payments would be due. And so you'll see here that as time goes on, the amount of the discount, it will decrease each time, and you'll add that to the carrying value, because you just take the total amount of the discount, which is 9,138, divided by the 6 payments. You know it will be 1,523 per period. Again, straight line bond issuance and discount amortization. Paulson Company issues 6% 4-year bonds on December 31st of 2019 with a par value of 200,000 and semi-annual interest payments. Use a straight line bond amortization table to prepare journal entries for the following. And so the first thing would be, we know that we're selling them at a discount. We receive cash debit of 186,534, and then a debit on the bonds payable of 13,466. Credit to bonds payable for 200,000, because at the end we're going to have to pay 200,000. Initially, we're only receiving 186,534, and we can figure that out by looking at the amortization table, and we see that initially for 12/31, of 19, that's when the bonds were issued, we see that the carrying cost was $186,534. And the first interest payment, then we can figure that out. We set it 6%. So each 6 months you're paying 3%. So you have bond interest expense of $7,683. So you have the discount on the bonds payable. So again, 13,466 minus 11,782 is 1,683. And you know that because you're going to take the total amount of discount, divide that by the total number of payments. And so in this case, it's a 4-year bond. So you know that there's going to be 8 payments made if they're making payments every 6 months. And so you can figure that out. And then the amount of cash that you're paying then is 200,000 multiplied by 3% is 6,000. Okay. Because you're not paying the discount right now, but you'll pay that at the end. And then the second interest payment, again, the same thing. Dobbs issues 5% 2-year bonds on December 31st of 19 with a par value of $200,000 in semi-annual payments. So we'll use a straight line bond amortization table to prepare the journal entries. And so we see that the issuance of bonds on December 31 of 19 is you have cash in the amount of 188,000 because that's the amount of cash that we're receiving. We figure that out by looking here at the carrying value. Then the discount on bonds payable is 12,000. You can take, you know that the bonds had a par value of 200,000. So we can take 200,000, subtract the amount of cash received, then that gets you the discount. And then you have a credit for bonds payable of 200,000. And then we can record the first interest payments. We know that it is a 5% 2-year bond. So we know that we're going to have to make 4 interest payments. And half of 5 is 2.5. And so you have bond interest expense debit for the first payment of 8,000, credit to the discount on bonds payable of 3,000. Again, 12,000 minus the 9 is 3,000. Or you could take the total 12,000, divide it by total of 4 payments. That's going to get you the same credit, and then credit to cash the amount of 5,000. Now, in this case, each entry then would be exactly the same. The only thing that you would do is you would just change to reflect the unamortized amount of the discount, but the amount for the debits and credits would be the same. Okay, so then what we can do is we can record the maturity of the bond. And so on December 31st of 2021, you have bonds payable in the amount of 200,000 and you have cash in the amount of 200,000 because 200,000 is the par value of the bonds. That's what would be due at the end of the 2 years. So you want to debit the bonds payable 200,000 because that clears the liability for the bonds, and then credit cash 200,000 because that is what you're paying out. Look at the bond retirement by call option. Tyrell Company issued callable bonds with a par value of $10,000. The call option requires that Tyrell pay a call premium of $500 plus par, or a total of $10,500 to bondholders to retire the bonds. So that's what it means. If it's a callable option, that means that the company, in this case, Tyrell Company, can pay off the bonds early. And in order to do that and exercise that right, it's going to cost the Tyrell Company an extra $500 to be able to pay off the bonds early. Okay, and they issue what's called a call. So on July 1st, Tyrell exercises the call option. The call option is exercised after the semi-annual interest is paid the day before on June the 30th. So we'll record the entry to retire the bonds under each separate situation. So the first one will say that the bonds had a carrying value of $9,000. So we would debit the bonds payable, the amount of $10,000, because we're now paying off that liability. We would also have a debit to the loss of on retirement of bonds for $1,500. And then you would credit the discount on bonds payable $1,000, and cash would be, again, the par value plus the call option, a credit of $10,500. And again, the gain or loss right here is calculated between the difference of the carrying value and the amount that's required to pay. So we know that we have to pay $10,000, but the amount of the carrying value at this point is $9,000. So the difference between the two. But also you have to remember too, also the $500, which is the call option to exercise that. So then if you look here, the next one, let's say that it had a value of $11,000. So you'd have a debit to bonds payable of $10,000, and then a premium of bonds payable $1,000, and then a credit to the gain on the retirement of bonds of $500, and then a credit to cash for $10,500, because you have the par value plus the call discount. Look at another one that maybe will make that a little bit clearer. On January the 1st of 2019, Shea issues $260,000 of 8% 20-year bonds. The bonds sell for $251,600. 6 years later, on January the 1st of 2025, Shea retires these bonds by buying them on the open market for $273,650. All interest is accounted for and paid through December 31st of 2024, the day before the purchase. The straight line method is used to amortize any bond discount. So first of all, we need to figure out what the bond discount was, because it was a $260,000 par value, but the bonds actually sold for $251,600. So we take $260,000, subtract $251,600 from that. You come out with that the amount of the discount at bond issuance was $8,400. So then you can figure out then how much the amortization of the discount is recorded for the bonds from the entire period from January the 1st of 19 to December 31st of 2024. So you have the original discount of $8,400. You have the bonds term, which is 20 years. So you take $8,400, divide by 20, you get $420 a year of straight line amortization. And so the years that were amortized through the date of sale was 6 years. And then the amortization that happened through December 31 of 2024 is $2,520. And so we want to know then what the carrying or book value of the bonds as of the close of business on December 31st of 2024. So again, the par value was $260,000. The remaining discount, so you take $8,400 minus the amount that already had been amortized of $2,520, gives you $5,880. The carrying value then, if you subtract those, is $254,120. And so the amount of gain or loss. So you have the carrying value of the retired bonds on January the 1st of 2025 of $254,120. The amount paid to retire the bonds was $273,650, and so the loss on retirement was $19,530. And so then to go ahead and record the journal entry for the bond retirement on January the 1st of 2025 is you have bonds payable, the amount of $260,000, because that is what is due back to shareholders, the principal on the bonds. You will also debit for the loss on the retirement of the bonds of $19,530, and you would credit the discount on bonds payable for $5,880, because that's the remaining discount, and then you would go ahead then and credit cash in the amount of $273,650, because that's the amount of cash that's paid out. Installment note amortization table and how that's calculated. So on January the 1st of 2019, Eagle Company borrows $100,000 in cash by signing a 4-year 7% installment note. The note requires 4 equal payments of $29,523, consisting of accrued interest and principal on December 31st of each year from 2019 through 2020. So we're going to prepare the amortization table for the installment note. First of all, we want to figure out what the interest expense would be, and so we'll figure that out by taking the beginning balance multiplied by the interest rate, which in this case is 7%. So in 2019, we see that the amount of interest expense would be $7,000. Figure out the principal. You're going to take the amount of the payment, which is $29,530, subtract the amount of interest expense of $7,000. That gives you that you are paying off $22,523 of principal. And so the ending balance, principal balance on a loan, is $77,477. That then becomes the beginning balance for 20, and then we can figure out then $77,477 multiplied by 7% then is $5,423 in interest. So if you take again, the cash payment would stay the same, $29,523. You take that, subtract the amount of interest. That's going to tell you how much principal is being paid. In this case, it would be the debit to notes payable when we go to journalize this. It means that the ending balance then is $53,377. That becomes your new balance for 21. Again, multiply the new balance, $53,377, by 7%. That's going to give you then that you're paying $3,736 of interest. And again, you subtract that from the cash payment amount. That's going to give you the notes payable, the principal amount that's being paid of $25,788. So if you subtract that from the beginning balance, gives you an ending balance of $27,590. And so that becomes the beginning balance in 22. And then you have, again, you take the beginning balance multiplied by 7%. That's going to give you $1,933. And then you know that the payment amount, again, that's going to stay the same, $29,523. So you take that, subtract from that, $1,933 gives you the principal balance that's being paid of $27,590. So then that would mean then that the ending balance then on a loan is 0. Again, you can add up to figure out then the total of interest expense. In this case, this would cost the Eagle Company a total of $18,092 in interest. Again, the balance, they're going to pay $100,000 back, they're on their loan. And then the total for the cash payments then would be, the total of both of those is $118,092. So now looking at the same scenario and the table that we just looked at and we figured out, we're now going to go ahead and record the payments for these. Prepare the journal entries for Eagle to record the loan on January the 1st of 2019 and the 4 payments on December 31st of 19 through the December 31st of 2022. So let me go ahead and bring up our amortization table. The first one is to record the actual note itself. So we have a debit to cash in the amount of 100,000 and a credit to notes payable in the amount of 100,000, because that's the amount that we're receiving from our lender. Okay. Now, then we want to record the first payment. You would record interest expense debit, the amount of $7,000. Again, the beginning balance of the loan multiplied by the interest rate gives you that. And then the amount notes payable, debit of $22,523, because that's the amount of the payment that goes towards paying down the note. And then you would credit cash the amount of $29,523, which is the amount of the actual payment that we're sending. And so then for the next year, you're going to do the same thing, except that the amount of interest is going to change, the amount of the notes payable is going to change. And so then the new balance then would be $77,477. So you take 7% of that is $5,423 for the debit to interest expense, and then the notes payable would be $24,100, because that's the amount of principals being paid off, credit to cash, and then same thing here. So I'm not going to go over this, but you can see. We'll apply the debt to equity ratio. Montclair Company is considering a project that will require a $500,000 loan. It presently has a total liability of $220,000 and total assets of $610,000. And so the first thing we'll do is we will compute Montclair's present debt to equity ratio, and then we will compute the debt to equity ratio, assuming that it does borrow the $500,000 for the project. And so all you have to do to figure out the debt to equity ratio is just take the total amount of debt. In this case, they have $220,000. Divide that by the amount of equity that they have, which is $390,000. Again, you take the amount of assets, subtract from that the amount of debt that they have. That's how you're going to get the equity. So that equals 0.56. And then after the loan, we see here then that a $500,000 loan, so $720,000, they still have the same amount of equity. So then the debt to equity ratio then is 1.85. The bond interest and price at bond issuance. So Brigham Company issues bonds that have a par value of $800,000 on their stated due date. The bonds mature in 10 years and pay 6% annual interest in semi-annual payments. On the issue date, the market rate of the bonds was 8%. So first of all, we want to figure out the amount of semi-annual interest on the bonds. So we take the par value multiplied by the semi-annual stated rate, which is 3%, because half of 6 is 3. Okay, because remember, 6 is the annual rate. So then the semi-annual cash interest payment then is $24,000. And so then we need to figure out how much interest payments would be made on, or how many interest payments would be made on the loan over their life. So 2 payments each year for 10 years is 20 annual payments. And then use the interest rate given to determine whether the bonds are issued at par, at a discount, or premium. So we said that when the market rate is greater than the stated value, they're being sold at a discount. When the market rate is lower than the stated value, the bonds sell at a premium. Compute the price of the bonds as of their issue date, and then bonds sell for the present value of the future cash flow. So N is the 20, which is the number of semi-annual loan payments. I is the interest rate, 4% semi-annual interest rate, which is the market rate. So the cash flow at maturity then is the par value maturity is 0.5 4,564, and you would look at your table for that for the present value of $1. And so you look at the rate. We said it's at 4% for 20 periods. That's where you're going to get that from. So you take that, multiply by the amount of 800,000. That's going to get you the total present value. And then the interest rate of an annuity would be 13.5903 for 24,000, because that is the amount of interest. And so you get 326,167. And again, if you look 4% and a number of periods, that's where you're going to find that number. And then what we'll do then is we will figure out the entry to record issuance. So we receive cash in the amount of 691,280. And then we have a discount on bonds debit of 108,713. And then we have a credit to bonds payable in the amount of 800,000, because they're going to eventually owe 800,000. They're receiving 691,287. The difference that they're going to have to make up, which is the discount, is 108,713, because they're going to eventually have to pay back 800,000, but they're not receiving that all right away. To be dealing with the effective interest of amortization of a bond discount. Stanford issues bonds with a par value of $500,000 on January the 1st of 19. The bond's annual contract rate is 9%, and the interest is paid semi-annually on June 30th and December 31st. The bonds mature in 3 years. The annual market rate at the time of issuance was 12%. And so the bonds were sold for $463,140. And so we know that the bonds, because the market rate is higher than what the contract rate is, we know that the bonds are being sold at a discount. So the first thing we want to figure out is the amount of the discount of these bonds at issuance. So again, 500,000 is the par value. That's the amount that would have to be paid back at the end in retirement of the bond. Subtract 463,140. That's the amount that Stanford is receiving at this time. So the amount of the discount on the bonds is 36,860. And then you want to figure out how much total bond interest expense would be recognized over the life of the loan. So again, it is a 3-year loan, and so you're making payments twice a year. So you're making a total of 6 semi-annual payments. We know that the payment for the interest would be $22,500, because you take the 500,000 multiplied by 9 divided by 2 is 135,000, plus the discount on the bonds payable of 36,860. And so then the total interest recognized over the life of the bond then is 171,860. Again, the reason for that is 135,000 is the interest. At the end, you're going to have to pay an additional 36,860, which is the amount of the discount that was involved. And then you can figure out then, based on this, you can use the effective interest method to amortize the discount on these. And so for the first year, the unamortized discount is 36,860. So then, and the carrying value was 463,140. And so for the first annual payment, each or semi-annual payment, each payment interest is going to be 22,500. The bond interest expense is going to be a little bit more, because you have, so the total would be, so the bond interest expense is 27,788, because that is half of the amount of the interest for that year. And then the amortization amount is $5,288 for the discount, because as time goes on, because the discount is $36,860, you would divide that by the number of payments, which is 6. That tells you then how much then for each, with each payment, until you get to the total amount of the discount. We'll learn how do we account for leases. So on January the 1st, Harbor, which is the lessee, signs a 5-year lease for equipment that is accounted for as a finance lease. The lease requires 5 $10,000 lease payments, the first at the beginning of the lease and the rest at December 31st of the years 1, 2, 3, and 4. And the present value of the 5 annual lease payments is $41,000 based on a 7% interest rate. So the first thing that we'll do is you'll record the journal entry that Harbor will record at the inception of the lease for any asset or liability. So you have a right of use lease for $41,000, debit, and then a credit to the lease liability for $41,000, because they owe, that's what they owe, and that's would be the total amount of the lease payments. Compare the January 1st entry that Harbor will record for the first $10,000 lease payment. So you have lease liability, debit, the amount of $10,000, and then credit for cash, the amount of $10,000, because you're reducing, you're going to have to make 4 payment or 5 payments of $10,000. And so you're making the first one now, so you're going to have to reduce the liability for the lease of $10,000 and then credit cash because you're paying out cash. Now, if the leased asset has a 5-year useful life and no salvage value, you can prepare the journal entry that Harbor would record each year for the amortization of the leased asset. So you have the amortization expense, right of use asset, debit for $8,200, credit to accumulated amortization, the right of use asset for $8,200. And we'll look at a lease, but this time it'll be with a purchase option. General Motors advertised 3 alternatives for a 25-month lease on a new Blazer. The first one is $0 down and a lease payment of $1,750 per month for 25 months, a $5,000 down and then $1,500 a month for 25 months, or $38,500 down and no payments for 25 months. And so calculate the total present value of the lease payments under the 3 alternatives, assuming that the annual interest rate is 12% that's compounded monthly. So again, the number of payments is 25 because it's a 25-month lease, and then it would be 12% annual rate, so it'd be 1% for each month. And so we can look at the first one, option 1, which is to pay $0 down and in a lease payment of $1,750 per month for 25 months. And so then we know that the down payment would be 1.0 because it's zero present value. But if you look at that, the amount of the payment, which is $1,750, and then again figuring out that the number of periods is going to be a present value for an annuity. So it's a 25 month, so the number of periods is 25, and then again 1% each month. So that's where you get 22.0232, and this is the present value of an annuity. So total present value then is $38,541. And the second option is to pay a $5,000 down payment and then $1,500 a month for 25 months. And so the present value of the down payment, so would be $5,000. And then the monthly payments, then it would be the same because it's $1. So the table value would be the same, but the amount then of the payment then is $1,500. So if you multiply 22.0232 by 1,500, you get the present value, which is $33,035. So the total present value, then you add those up, is $38,035. And then the option to pay the full $38,500 up front costs you $38,500. So now indicate what the best alternative, assume that you had enough cash to accept the alternative. And so if you look, you see then that the one that has the lowest present value would be option 2, is to put the money down, the $5,000 down, and then to pay the $1,500 a month. Because by doing that, you would save a total $506 over the course of the 2 years, roughly 2 years, 25 months.